Hi there, welcome to Kneppy Invest. Let's talk Kogan. Is this one of the most polarizing companies on the ASX? And we have seen quite a few headwinds really factor in a decrease in the valuation of this company from a share price of about $25 in 2020, I think that was October 2020, to a low in the share price of under $3 in the second half of 2022. And it's really interesting because this company is in the right space. If you don't know what Kogan does, maybe you should get out of your cave and visit the world more often, because Kogan is all about online retail. Now, they're a little bit more diversified than that because they've also have Kogan Marketplace, Kogan Mobile, Kogan Internet, Kogan Insurance, Kogan Travel, Kogan Money, Kogan Cars, Kogan Energy, Dick Smith, Matt Blatt, and Mighty 8. But I think of Kogan as just an online retail company. I have used Kogan in the past, but not in the last 3 to 4 years. I am an Amazon Prime customer, user, subscriber. That's probably the best word. And one of the reasons that I am an Amazon Prime subscriber is simply because it doesn't take long for stuff you order to get to your place. In fact, I ordered something last night at 6 p.m. It arrived on my doorstep the next morning at 9 a.m. Now, that does not mean Kogan can't do the same thing, but every single time I've compared prices at Kogan versus Amazon versus JB Hi-Fi, etc., Amazon usually comes out ahead. And one of the bear cases in regards to Kogan is just that competition, particularly Amazon. But in my opinion, there is a place in the Australian on-tail retail place for not only Amazon, but also Kogan. So actually, I am a shareholder of a Kogan, but on the other hand, I am also a shareholder of Amazon. But I do think Kogan can be successful because online retail is going to expand from where we are now. It has contracted in the last year or so just because we had just passed COVID-19 and online spending or retail exploded because of lockdowns. And of course, that will always going to pull back. And we have seen that decrease in Kogan's valuation. But it does look like the sentiment in this company is starting to shift from highly negative to even positive. So let's have a look at Kogan and we'll talk about the CEO. I do have a few issues with the CEO and the founder. We'll look at their financial numbers, have a look at that chart, and maybe talk about some other things in regards to Kogan. I've already given away that I am a Kogan shareholder. In fact, I've been a Kogan shareholder off and on over the past 6 years, ever since they listed on the ASX. In fact, I bought into Kogan just after they listed, or maybe 6 months after they listed. And one of the reasons I decided to take a position in Kogan is because I actually was using the services back then. And now I've gone from using Kogan, Amazon, a few other retail, online retail places, and now simply focused on Amazon, unless Amazon doesn't have something I actually do need. I do prefer to shop online compared to going to those physical stores. That's just me. I don't like spending time or my time in places that are crowded, and I really hate crowded spaces, and shopping malls and shopping places are absolutely crowded, or can be crowded at times. I went to the supermarket today and I didn't like it. When at about 10 to 11 a.m. it was crowded. I prefer to do my food shopping between 7 and 8 because supermarkets at that point in time are almost completely empty and I have the whole supermarket to myself. But I am rambling on right now. But I do believe this online retail trend will only get bigger through time. Say what you think about Ruslan Kogan, but he has done an absolutely wonderful job starting Kogan in 2006 in his parents' garage. I think he's sold televisions at that point in time, televisions that were made in China. He expanded Kogan quite rapidly after that. Now, he's not only the founder, the CEO, also executive director. There is an argument, and I would listen to this argument quite closely, that the skill set that Ruslan Kogan has brought to Kogan is no longer applicable to grow this company to be a multi-billion-dollar behemoth. And maybe they should bring in someone else to run this company who has a different skill set. Now, I could be completely mistaken, But sometimes a founder can only run a company so long, and then you have to bring in someone else. So that's something hopefully Russ and Kogan and the directors of this company have been thinking about over the past year. So I have no idea if they've been thinking about that, but it's something they should be thinking about, in my opinion. Now onto the quality of Kogan. This is quite important at times, trying to decide whether a company is high quality or low quality. And this is important for me and my investing style, because I do treat high quality companies quite a bit different than low quality companies. And I am torn between considering Kogan as a high quality company and a low quality company. So I'm probably somewhere in between. I think there is potential that Kogan could be a high quality company through time. Say in 10 years' time, I think there's definitely that potential. I would consider this company to be a high quality company. And if it's a high quality company, it all comes back to value. And if I saw the share price drop from $25 to $3 and I thought there was value, like Kogan has done, I would not be hesitant in adding to my position in a company. So I haven't done that with Kogan. And one of the reasons is I don't think Kogan is or should be considered as a high quality company just yet. So it's probably not low quality either. And one of the reasons I don't think it's low quality is just because of that potential of a massive increase in the total addressable market this company has over the next few decades. And because of that, I'm going to say Kogan is sort of in between being a high quality company and a low quality company. You could even argue it's transitioning from being a low quality company to high quality, and that transition could take 5 to 10 years. One could say and argue that because Kogan was not profitable in financial year 22, that would sort of give us a clue that this company is not high quality. But I probably would counter argue that profit can be manipulated to the high side or to the low side, depending on the accountant in charge of the numbers. And also, I like to not only look at profit, I like to look at operating cash flow, free cash flow, revenue growth. Also, I like to look at profit, operating cash flow, free cash flow over a number of years. So I just don't look at one number. And some investors do this. They just look at profit and determine the quality of the company by that one number in that 1 year. So we don't want to do that. We want to look at the company as a whole and all these numbers as a whole and draw a picture from all those numbers. Anyway, at a share price of $4.37, Kogan has a market cap of $468 million, which is actually lower than Satire. And I do think Satire or Kogan is a better quality company than Satire. But again, that could be an argument for another day. And when the share price of Kogan was about $25, that means the market cap of this company was about $2 billion. That is the potential, I think, is there for Kogan over the next 5 years to get back up to $2 billion and even further than that. Now onto the financial year 22 numbers. Revenue $718 million. We'll look at the revenue growth in the next slide. I think a 10-year revenue growth, and we have seen significant revenue growth over that period of time. Company was loss-making by $36.3 million in financial year 22, but they were operating cash flow and free cash flow positive by just over $50 million. And I'm going to discuss why there's a discrepancy between profit and the cash flow in the company in about 2 slides when we look at the reconciliation of profit to operating cash flow. So wait for that and we'll decide, or we'll see why there is a difference between those 2 numbers. Now on to Kogan's revenue growth. And the first thing I always look for when I'm researching a company is determining whether the revenue for a company is growing through time. In fact, I look at revenue per share growth because I think I've mentioned this a few times. The best indicator for a company's outperformance in terms of share price is actually revenue growth. It's not profit growth, not operating cash flow growth. It's not other things. It's actually revenue growth. And it does make sense if you actually delve deeply into the subject of revenue growth, because the way to look at it is if a company's revenue is actually not growing, it's actually dropping, the only way they can increase profits is by decreasing costs. And decreasing costs can only go so fast. So you really want to see a company increasing their revenue through time. And Kogan has definitely done that over the past 10 years. In fact, revenue has grown from 174 million to 718 million. Now, you might argue revenue dropped from 2021 to 2022, but that does not make a trend. That's just a one little blip in the revenue or the overall revenue growth story. And you can see that massive jump in revenue from 2020 to 2021, from 498 million to 781 million. Now, I also calculated the revenue growth per year, actually revenue per share growth per year, and it's at 16.9% over the last 5 years, 13.4% over the last 3 years. Sometimes I look at the 10-year compound annual growth in revenue, but 10 years ago, Kogan was not listed on the ASx, so we had no numbers for 10 years ago in terms of shares. We have the revenue for that year, but not the shares because there were no shares in this company. The other thing I've included here is just gross profit and total operating expenses, and both of those are going up gradually through time as well. So everything you want to see here in terms of revenue growth per share, it's above 10% per year. That's another thing I look for. When you do see the 10% or larger than 10% growth in revenue per share, that means more than likely, unless margins are decreasing, that means more than likely the valuation of the company will be growing at more than 10% per year following that. So if they can continue this growth moving forward, Kogan the share price should increase by at least 10% per year from here over the next 5 to 10 years. A lot of assumptions when you think that, but that's just looking at what's happened in the past. And if they can continue growing at this rate, that should happen in the future. So why was there a big difference between profit and operating cash flow? Not only was there a big difference between those two in 2022, there was actually a big difference in 2021 because Kogan was profitable by $3.5 million in 2021, but were operating cash flow negative by $63 million. So why was it a sudden shift in both of those numbers? Why was a sudden turnaround between the differences in profit and operating cash flow between last year and this year? And the most likely reason is changes in working capital. So changes in receivables, payables, and for Kogan, inventories. So in 2021, there was a massive increase in inventories, and this actually did cause problems for the company. In fact, they increased inventories by almost $90 million in financial year 21, and then they had too much inventory and they had to sell it during financial year 22. And in fact, there was a decrease in inventories by $62.1 million. So that change in working capital, that change in inventories was a big reason, not the only reason, but a big reason why there was a discrepancy between profit and operating cash flow, not only in 2022, but also 2021. But there's also some other reasons here. Depreciation and amortization, $19.2 million. Mighty Ape tranche 3 and 4 accrual. So obviously that has something to do with an acquisition they made of Mighty Ape, $17 million. Issue of performance rights and shares, $26.6 million. That's had a significant effect on the profit. Take that away, they were only unprofitable by about $9 million and a few other things, smaller things as well. So a lot of things going on here. My main concern when it comes back to Kogan is just that issue of performance rights and shares. I'm not sure they have to do that because, to be honest with you, the performance of Kogan and the management over the past year and a half has not been stellar. So whether they deserve performance rights and shares is another argument. Kogan was a dividend-paying company, but they haven't paid a dividend for just about a year. The last time they paid a dividend, or the company went ex-dividend, was the 8th of March, 2021. So this is actually from ComSec. So that dividend yield of 3.25% is not applicable because in the past year, this company has not issued a dividend. I would be surprised if Kogan didn't go back to paying dividend within the next year. But at this point in time, Kogan is not a dividend-paying company. Now onto the valuation for Kogan, and this slide becomes more important if you do consider Kogan to be a high-quality company. So if I thought Kogan was a high-quality company, I might be more interested in adding to my position because at this point in time, Kogan has been looking attractive in terms of valuation for quite a few months. Now, the company does not have a PE ratio because they were loss-making in financial year 22. So we have to look at some other valuation metrics. Price to sales ratio, I don't look at that all that often, but 0.7 for Kogan, that seems about justifiable or reasonable. Price to operating cash flow, this is one I do look at 9.6. And that is in the attractive range. So I do look at the price to operating cash flow for all companies. And if I see it between 6 and 10, I will take a closer look at the company. And then based off the company, I would consider 9.6 to be either attractive or maybe justifiable. So for Kogan, that's sort of in the sweet spot when it comes to price to operating cash flow. We also did a reverse DCF based off the free cash flow. So instead of using the operating cash flow, we use the free cash flow just to be a little bit more conservative. Can't use the earnings per share because, of course, they have no earnings. Now, based off the free cash flow, for this company's current valuation to be justifiable, Kogan will only have to grow their free cash flow at 1.1% per year over the next 10 years. And do you think they can do that? I think they can definitely do that over the next 10 years. And that's one of the reasons I do think Kogan is attractive right now just based on valuation. And possibly the market is seeing some value with Kogan right now because definitely, even though the share price was in a well-defined downtrend and that negative sentiment drove the share price down from $25 all the way down to a low of about $2.70, which was reached in late July, early August of last year. We did see then the share price go sideways after a very big bounce in the share price in late July. And we have seen a bit of a shift in sentiment since the start of this calendar year, since the start of 2023. Share price has moved into an uptrend. I'm going to call it right now. It's a fairly weak uptrend, but the share price is trending upwards. In fact, the share price has moved above most of the moving averages I do look at. The last moving average it's moved above was the 150-day and the 200-day moving average. That's a good sign that the trend is starting to shift from negative to positive, from downward to upward, and the sentiment definitely has shifted over the past few months for this company. So I'd not be surprised to see the share price move higher from here. But the share price right now is in a little bit of a resistance zone. You can see share price is struggling to get above about $4.70. The reason that's a resistance zone, and we're in a resistance zone right now, is if we go back to that big bounce in late July, early August, that's what the share price got to. So there would be some shareholders who bought in then, who have seen the opportunity to sell out right now, and that's why the share price is struggling. Not only that, we have a lot of shareholders who bought in the last few years at much higher share prices, who are seeing the share price of Kogan going a little bit of a run and just waiting for the opportunity to sell out of this dog stock. So don't forget, investors who see the share price of a company they just bought into fall just after they bought in automatically consider that company a dog stock, and they just can't wait to get out. So they wait for the share price to rebound back up to where they bought in, and then they sell. And that is resistance. So whenever you see the share price drop like we have seen with Kogan over the past few years, there is always going to be resistance for the share price to move higher. But that resistance back in late July, early August is very close resistance. And that's why right now the share price of Kogan is struggling to get above that level. The next 5 companies I plan to feature in this Kneppy analysis series include Goodman Group, Cochlear, XRF Scientific, Levisa, and the next video I will do is on James Hardie. I've already prepared that video, and I had never looked at James Hardie in the past. I had a slight inkling on what they do, but James Hardie is an intriguing company, particularly because the share price has fallen a fair bit over the past year. That's all I have for this Kneppy's analysis video on Kogan. If you have any thoughts about this company, whether it's negative or positive, I'd love to hear it. So leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.